Welcome to PropPro 247, amazing suite of calculators, systems, tools, valuation calculators, etc. Your property genie. This video we will focus on the business valuation calculator, the do's and don'ts, the correct formula for evaluation, and focus on how funders and potential buyers of business, the formula which they look at. Let's get straight to the calculator itself. Right, you will notice the input fields are limited and everything else is automated for your convenience. Let's have a look at a typical small business valuation. Looking at net current assets of 100,000, fixed assets 250,000. We've got 5-year financial statements. The latest one suggests perhaps 800,000 net profit after tax. Year 2, 700, 650,000. Back to 800,000 for example purposes, and 675,000. The price earnings ratio for this particular type of business model, let's start off at a 2. This is optional field if the particular owner has been drawing excessive salary out of the business, far above that of a market-related manager's salary. We input that and it will add to the net profit. So let's skip that field for purposes of the video. Here we add factors which could influence positively or negatively against the value of the actual business. For example, our expected longevity of the business, let's say it's hugely positive. We'll add a 2%, for example. Are there known risks on the current margins by competitors, etc.? There are none. Are there known risks associated with rental agreements? None that we are aware of, and visible and attainable new opportunities. Let's say they really are, and we add 2% in this instance. If financed, insert a financed percentage. Let's say, for example, the particular we're doing this valuation for a buyer who's going to make use of 40% finance against the value of the business, and the banker's funders rate sitting at 9%. At this point, you've completed the entire valuation process of your business, and all reports, cash flows, and financial ratios have been produced for you. You will notice next to the input sheet, we have the input totals. It has managed to calculate the actual selling value of the business, the goodwill factor based on your price earnings ratio, and the average net profits after tax from the previous 5 years. You'll see the purchase price. In this instance, we were doing a 40% financing, so the cash amount would be that amount and the finance portion that amount. We've also calculated with the built-in loan calculator based on the interest rate and on terms over 3, 5, 7, and 10-year terms what your monthly repayment would be. Now, this is important for the financial formula which we have computed for you. The first report, we'll have a look at a total cash report. In other words, there is no financed amount. This is automatically produced for your convenience, and we can see all the cash flows have been computed here for a prospective buyer. You will also note that we have calculated the earnings over fixed assets as well as the earnings over the net current assets of your last financial year. The most important formula that we're looking at from a funder's perspective, from an investment analyst or even an accumulator of businesses, are the net present values of future cash flows, internal rate of return, and modified internal rate of return. Naturally, the net present value must be a positive amount, or else it is a negative investment. The internal rate of return and modified internal rate of return must both be above the hurdle rate of financier's rate in this instance. So let's have a look at a typical example over a 5-year report where the guy has made use of that 40% finance. In this instance, we have calculated the 5-year term, the cash flows, which are to be brought into the financial equations. Now, if I may for a moment delve in the difference between internal rate of return and modified internal rate of return. The internal rate of return has a flaw in the formula in that all positive cash flows, when the project becomes positive, it reinvests at its own internal rate of return. In other words, the rate which it generated in the first few years of the business. The modified internal rate of return, we are able to modify this in order to cap positive cash flows at the same rate as your funder's rate, which in this instance is 9%. The reason being is that it is conceivably possible that you invest surplus cash into your own debt. In other words, saving or securing a 9% in this instance. It is not possible to reinvest and have continued growth accumulating in the internal rate of return at that particular interest rate. So most modern investment theories work primarily on the MIRR. Now we have calculated this over a 10-year period as well, and you can see how your internal rate of return and modified internal rate of return deviate from one another, because we are presuming you can only get 9% return on your surplus cash. Now these reports are produced for you automatically in printable format to PDF with your logos, etc. And we pride ourselves in that any information that needs to change at any given time, should this not be suitable for a prospective buyer, you simply go to the input sheet and you recalculate. You have a look at the price earnings ratio, which calculates your goodwill factor. We have a look at perhaps a lower rate of 1,8, and automatically all your values would have changed, your returns would have changed in all your report sheets. Now we do have the commercial property, the development property valuations, and the business valuations available in web app, suitable for cell phone and iPad as well. I can briefly show you on a demo report which we have just completed, show you what it looks like in PDF form. It produces all the various cash flow periods and financial formula. I certainly hope you've enjoyed your time watching the Business Valuation Analyst in action. We automate so that you can operate. Enjoy your day further. Thank you.